Small-sized hail destroys a roof, the resulting insurance claim often runs into the tens of thousands of dollars. As severe weather events increase in frequency across the country, insurance companies are bleeding cash. To compensate for these massive physical losses and rising inflation, insurers are hiking premiums to record highs. In markets like South Carolina, regulatory filings show providers pushing rate increases anywhere from 5 to 26% in a single year. This pricing surge is forcing 1 in 4 homeowners to actively alter their insurance policies just to keep their monthly mortgage payments affordable. But insurance providers are reacting to this market pressure by quietly changing the math. They are rewriting the fine print in renewal packets to shift the financial risk of a total catastrophic loss straight back onto the homeowner. You are caught in the financial trap. You either pay the surging, painful monthly premiums, or you pull the wrong cost-saving lever and unknowingly expose yourself to a devastating out-of-pocket bill the next time a storm hits. Right now, 18% of American homeowners are operating with underinsured properties. If their house is severely damaged today, their current policy will not cover the full cost to rebuild it. The true rate of underinsurance is likely much higher because an additional 38% of homeowners admit they do not know how to determine if they actually have enough coverage. Despite this massive blind spot, 25% of homeowners are taking a massive risk by actively stripping away coverages or reducing their total limits to shrink their monthly bills. This chart compares homeowners actively raising their deductibles against the reality of their bank balances. It shows a severe mismatch. While many are raising deductibles to save money, 59% of homeowners do not have $5,000 in liquid cash to cover an out-of-pocket emergency. Without that cash liquidity, lowering your premium by taking on a higher deductible often leads to a cycle of debt or foreclosure. If a major storm hits, you won't be able to pay the initial deductible, meaning repairs can't begin, leaving your home damaged. The most financially dangerous policy shift insurers are currently sneaking into renewal documents involves exactly how they value your roof. This matrix illustrates your coverage options. The gold standard is replacement cost value, or RCV. It pays the full market rate to replace your roof, regardless of age. But if your roof exceeds 15 years, insurers may require inspections or drop coverage. To lower premiums, insurers offer actual cash value and roof payment schedules. These factor in depreciation. On a roof schedule, if your roof is 15 years old, the policy might cover just 40%. If a new roof costs $10,000, that leaves you on the hook for the remaining $6,000. Accepting a roof schedule to get a cheaper monthly bill is essentially taking out a high-risk loan against your own roof's inevitable failure. The second major lever homeowners pull to survive rate hikes is increasing their fixed deductible to immediately drop their annual overhead cost. It is mathematically appealing to combat a premium hike by raising a standard $1,000 deductible up to $5,000 or more, but this choice has a strict hidden requirement. It mandates that you permanently park $5,000 in a highly liquid, easily accessible emergency bank account. Since the majority of Americans do not have this cash, a major damage event leaves them completely unable to even initiate contractor repairs. A high deductible is only a valid cost-saving tool if you have the liquidity to self-insure the gap. Without that cash, it is a gamble you cannot mathematically afford to lose. The third hidden danger of a stripped-down policy involves the physical appearance and curb appeal of partial repairs. Standard policies only cover the exact specific section of a roof or siding wall that was physically damaged by a localized event. If original siding is discontinued, out of stock, or faded from the sun, the newly repaired section will violently clash with the rest of the house. A patchwork, inconsistent exterior drastically reduces the multi-$100,000 resale valuation of your property. This diagram shows the solution: the matching of undamaged siding or roofing endorsement. An endorsement is an add-on provision that alters the scope of your policy. It legally forces the insurer to replace the entire exterior to maintain a cohesive look across the property, requiring only a slight bump in your monthly premium. This matching endorsement serves as a financial shield, protecting your home's equity from the immediate depreciation that follows a mismatched exterior. Which exact policy dials should you turn based on your day-to-day financial situation? This flowchart plots a decision framework that splits homeowners into two distinct profiles: the cash-poor budget-conscious homeowner, and the cash-rich optimizer. If you are budget-conscious with limited liquid savings, do not take the bait on actual cash value or roof payment schedules. You must keep your deductibles low and prioritize replacement cost value coverage, even if the monthly premium is painful to pay. Your only safe cost-saving action is to aggressively shop for new providers. Stripping away your coverage limits to save a few dollars leaves you exposed. Now consider the optimizer profile, homeowners with high home equity and substantial cash sitting in the bank. You can confidently raise your deductible to $5,000 to slash your premiums, using your liquid cash to self-insure against small claims. You should then reinvest a fraction of those premium savings into the aesthetic matching endorsement to fiercely protect your property's resale valuation. Home insurance is no longer a set-it-and-forget-it utility that you can safely ignore inside a mortgage escrow account. You must audit your current renewal documents immediately. Look past a premium price and hunt for the dangerous terms, actual cash value, or payment schedule. True financial security requires an insurance policy that accounts for your actual liquid cash reserves.